Hey everybody, Paul here again. Just a quick little update on the weekend. Just going to go over some thoughts of the upcoming week, going into the new year, where I've been for 2019, and where I kind of think we're going. So, I've gotten a little more positive on the market. Right now, I'm sitting at a 40, or actually 41.59 exposure to the market. I have just been kind of looking what's going on in December. Um, just various different things that are going on. And I've been looking at the YouTube community. The YouTube community is, I guess, the best way to describe it, polarized at the moment. It's either you have guys who think it's gonna go great, everything's perfect, there's no recession coming, so go 100% into the market. And then there's another section of the community, kind of, I guess you can call it the Peter Schiff side of the community. Every single video they put out is some type of doom. I guess that's the best way to describe it. It's just doom, doom, doom. All hell's gonna break loose at some point. Um, and then if you look at the super positive side of the community, when the market was going down a year ago, they didn't know what to do. they it was pretty rough when the Fed was actually tightening and credit was getting tight, and before they started this non QE thing, they were very confused on where to put their money because their growth strategy, which is basically just tech, anything tech, just throw money into it and just come back in a year and have, here's your 100% return. They didn't know what to do. And yeah. So it's going to be interesting to see how all these people react to an actual recession. Um, so how's Paul's portfolio doing? I am up to 30,394. That's when you combine 401k, savings, whatnot. In the stock portfolio, I am up to 24,401. My last video, I believe I was at 23,897, give or take a little. I'm still positive in December. I'm actually very positive in December. Um, I'm I'm not that exposed to growth sectors, so I haven't caught that Nasdaq trip up to the moon. But as it stands right now, I'm doing pretty good. So I've put in about $410 in the past week or so. So I just kind of wanted to go over where I put the money, where I think everything's going, that kind of thing. Pretty much every day I've been positive. Just kind of the way that this portfolio is structured, that even if the market goes down, the money goes into bonds. I still make money off of the bonds. And so where I've put money over the past week is I've increased my positions in Coke just a little bit. So I own 12 shares now. Um, I could see going far more heavily into Coke. So if Coke pulls back to about 53, which I hope it does, preferably I prefer 50. But if it pulls back to 53, I'll more than likely take about maybe 300, 400 more dollars and drop it in the Coke easily. Um, I added a position into something called EWU. So if you don't know anything about, and this is another thing about YouTubers that kind of gets on my nerves, is they're very U.S. focused, and I don't think they understand how to get exposure to other places. They think you have to trade on these other markets and then have all that tax exposure. It's kind of crazy because a lot of them will talk about Vanguard or like just these different type of funds, these index funds that track other markets, but they don't invest in them, and then they seem very confused. So that's, if a recession hits the U.S., they're going to be really, really in trouble. So simple ways to get exposure to just different countries. Period. So this is a highly diversified account. If you look into the prospectus of it and just the different annual reports that they send out, it literally breaks down by country, by currency, by whose debt is in these things, um, just to kind of see, what are you getting yourself exposed to? Because outside of the U.S., valuations are really low. Like for example, this one is VYMI, and it has a 11 PE. That's super low compared to the US. The US, like some of these companies in the US are getting up to 19, 23 on some of these, and people are saying that's fair. That's really high compared to historical. If the market is trading at an 18, you have solid companies, like good US companies trading at 23. That tells me that once the Fed stops, there's a pullback coming. People are going to take profits. So this one, for example, has like Taiwan Semiconductor, Toyota Motor Corp, Total SA, AstraZeneca, Royal Dutch Shell. This is the country exposure right here. So this is your biggest ones right there. Other. So you might be asking yourself, well, okay, well, I have that. What does all this actually mean? So for E-Trade, for example, they actually give you the different reports. So the Morningstar report is just going to be the short thing. It's going to have tons and tons of numbers on it. And it's just basically performance, very like summary, where Morningstar, how they feel about it, their little different scores that they give it, and then tons of pages of just notices saying that they could be wrong. The fund report, this is like an E-Trade fund report. This is pretty much identical. It's just basically what do they think the risks are, what's the biggest countries they're exposed to, that type of thing. What people need to learn how to read, and I think a lot of people have trouble doing this, is called an annual report. E-Trade makes it one click away. I guarantee Fidelity, Schwab, whoever you trade. If you don't have access to this, then you need to just find it. Morningstar has a website where they have these things. Seeking Alpha probably has it. SeekingAlpha.com. But you need to learn how to read these. And this will tell you what you're actually exposed to and how much. So it's always going to have normally an annual report that they put out once a year. And this last one was 2018, or a semi-annual report that will be in the current year. The very first page of it is literally the person who manages the fund telling you where they think the world is going. And you can kind of see how things are advancing. But it literally tells you, so you find the name of your fund. So for example, this one, so some of these will have like 6 or 7 different funds on it, and they break them down. So you have to find the pages that have your funds on it. But if, for example, this one has the fund that you were just looking at, and if you're worried about too much China exposure or whatnot, or, too much, for example, if I saw a lot of Argentina in here, I would not own this because they are in some pretty bad trouble. So this tells you what that other is, and it specifically tells you how many shares they have, what's the name of the companies that it's exposed to, what you're dealing with, and what's in these things. And it goes on for page after page after page just to give you a general idea of how huge these things are. And this one's kind of big, but I've seen some that are just massive, and it tells you how much money they're making. It breaks down the fees that you're getting charged on the management fees. Just everything. It literally tells you everything. These are things that they're required to report to the SEC. So whenever you're looking for international exposure, that's what I recommend you do, is just kind of look at what you're getting exposed to, look at the prospectus. If you feel comfortable with it, then it's a good investment. So this is the basically the stock equivalent of an international diversified fund. I own one that is called BNDX. This one I believe, I just added, this one just paid a $27 capital gains dividend on the 27th. I'll probably end up adding more into here. But this one works identical. So when you click into it, and what I really was attracted to with this one specifically was the monthly dividend. So this monthly dividend is incorrect. So this is actually showing the yearly, but this is the most recently one that's paid out. So it shows you their monthly dividend, and it also shows you their, they pay out a yearly dividend. But what I'm really want is this top part right here. And this is called credit quality. And I'll go over credit quality here in a second. But So what I'm looking for is what a lot of fund managers are looking for right now. So if you watch Bloomberg, if you watch CNBC, if you pretty much watch anybody, they're all trying to get exposure to higher credit quality, and there's a reason for that. So pretty much triple B and above right now is the place to be. Preferably triple A with really good returns, but not always going to happen. So these funds are made up of just different countries' debt. The tax exposure is inside of the fund itself. So you don't have to worry about paying international taxes. You're not going to get a bill from Germany that says you owe us money, because Vanguard takes care of all of that inside of the fund itself. Some of these, actually, the way that they treat it is they treat it as like a special type of tax. So Vanguard actually gets charged a less, it's preferential treatment. So it's the same way as if you buy a municipal bond in the U.S., you don't get charged taxes on that because you're buying that, the debt, and it's a specialized type of tax treatment. These are identical. And if you go into prospectus, you can find all of this. You just need to learn how to read this. Now, if I went out, some of this actually has corporate debt in it. And if I pull up the prospectus, you would see specifically what corporate bond debt is in here. If I went to that specific market and bought that specific company's bond, like the Nikkei or whatever, wherever it is, then yeah, I would have to pay taxes on that. Some people are getting, it's very weird how the YouTube community works. They're very, very US focused. And that's cool, but when you get into a recession, you're not going to know what to do with yourself. So year end, there's always this trend, and some people do it very heavily, as they say, go international, go international, go international. And it's not always a winning play, especially in the last few years with just easy money everywhere. So if you're ever looking for just different ways to get exposure outside of the U.S., the easiest way is just these two Vanguard funds. If you're looking for stock exposure outside of there's more than just this. You can research this. VYMI, very easy way to get stock exposure outside of the U.S. EWU. What is EWU? EWU is literally a play on the United Kingdom. United Kingdom ETF. Very, very easy ways to get exposure. It has it's called a semi-annual dividend. It is extremely simple to get exposure outside of the United States. The United Kingdom has a very preferential tax treatment, to be honest with you, with how they treat U.S. investors and how U.S. or United Kingdom investors are treated inside of the United States. So if you think Brexit is not going to really affect the UK economy and it's going to take off like a dart, so for example, it's trading at 33.98 right now. This is one I've actually been in and out of, and I've made money every single time I've been in it. But prior to all the Brexit goofiness, it was at 43. And now that it's sorted out, so if you think, and I mean, there's very clear up channels and very clear, where it bottoms out at. So you can kind of see, like, this thing bottoms out right around 28 whenever there's bad news that comes down. This last time it was at 31. Here's another one where it's 29. So it trades on Brexit news, basically. So if Brexit is going to go good, if the United Kingdom is going to get a good deal out of Brexit, the potential of this one to go up to 45, for example, or even higher, 42, if they get good treatment and a good trade deal and WTO rules work out for them, it's going to take off. Another reason why this one is just good is the simple fact that it's at a 13 PE. Like I said, the U.S. is at 18, 19, 23. Tesla's at like some crazy number. These are very solid companies inside of the United Kingdom. I have a feeling that, like, in this one, I believe this was at like a 12 or an 11, not even a few days before Brexit, or the Tories got a majority in their parliament. This one, if you're looking for exposure, these are just very simple ways to get exposure. If you think India is going to take off, if you're looking for an India focused one, there's one that's called, I put it on my watch list. There's a specific India one. This one right here, EPI, Wisdom Tree India Earnings. Dividend is not the most amazing thing in the world, but if you're looking for a way to quickly invest in a very specific India focused one, EPI is one. There's tons of these ones out there. This is my watch list. I keep tons and tons of stuff on this watch list. Some people, it's kind of crazy how the YouTube community works. They treat index funds like they're the worst thing that's ever existed on earth. And that is because in this bull market, any moron with $100 could have turned that into $200, investing and letting pretty much anything. It doesn't matter where you put your money. That's what a bull market is. It's literally, and this has been a very different bull markets because so much money has been pumped into the market. $1 trillion deficits, 3 rounds of QE, 57 rate cuts in 2019 alone, 3 from our central bank in the United States. Just the obscene amount of money pumped into this market is, it is these, the guys that are flashing their accounts around. Like I said, when a recession comes, I would love to see what their accounts look like. Just looking at what I looked at in 2018, looking at these same videos at the end of 2018, they did not know what to do. It's going to be funny watching these guys. If we actually get into a recession. So, what have I been up to in the last week? Like I said, I invested $410. I bought some more shares of LTC. This is a REIT, 17 PE. I'd prefer it lower, but if I get a 17 PE on a company that pays good dividends monthly, I'm jumping in easy. Positive earnings, 19-cent dividend per share, 19-cent dividend per share. Pretty solid company. Long-term care. Lots of boomers, these boomers that are retiring. A little trick that you can do if you pull up a calculator. I don't know if anybody knows how this works, but if you have a lot of boomers who were born in 1946, add 65 to that, 2011, okay? Just keep going. 1947 plus 65, 2012, you get the idea. There's a lot of people that are retiring. Some of them have lots of retirement savings. So they're just living in their houses, doing their things. Right now, they're selling their houses. These old, places in my area where I know there's a lot of old people living, a lot of those houses are for sale right now. This is called long-term care properties. Pretty common sense move right here is what's going on. There's a lot of people that are just older that are moving into these properties where utilities are included. They can pay for it with their Social Security checks, and there you go. It's not like convalescent, where they're going to die. It's just basically where they're going to kind of live out the rest of their lives. That's a pretty easy one. If you're young, trying to look for a way to cash in on boomers, if you got that okay boomer mentality, here you go. I've liked that one. I got money myself in there. I'm probably going to get far more exposure into this one. If this one pulls back, like I said last week, if this one pulls back to 40, I could easily see going further into it. Let's see what we got here. Energy continues this thing where it's climbing. This is based on oil. This is flat out based on oil. This has been one of the more interesting one. And this kind of started at the exact same time that the Fed started printing money like it was going out of style. So oil has gone up to, where's my little guy at? So go to CNBC, click right there. You can actually get a market view. This is something they don't do. They do like this little thing. But if you actually click the thing that says market, you get this view, which I actually like. Oil is going up to 61. And if you click on oil, in theory, you should get oil if CNBC is working. There we go. So this is a 1 year of oil. So in October, oil was at 52. Oil is at 61. This is the February contract. So the price at the pump for a lot of people is about to go up. That is not really good because that is literally the quickest way that you can see money pulled out of the economy going into the first quarter. I have a feeling that at some point people are going to cut back. We'll have to see how this goes. But for right now, that move after Saudi Aramco and all that, and the shale sector started to consolidate, um, that has been a very good move for December. Let's put it like that. That's a 7.5% return. Yeah, that's definitely been a good move. One of the crazier moves has still been J&J. Looks like it might have kind of figured out a spot where it's happy at. This one has a potential to move up too. Um, yeah, just these crazy moves. Um, and where let's see, I put money in LTC. I put money in EWU. If oil continues to move up, some people are saying $70 oil. I just don't see that happening. Because whenever oil gets to these little areas like 65, that kind of thing, then you start to see these massive builds in oil supply and these massive sell-offs. So if anything, if you're looking to take profits, now might be a good time going into the new year. So where do I see going into the new year? What's Paul's predictions? End of year. So if you want to see how Paul has done versus the rest of the market, if Idre would be so kind. Here we go. That's Paul pretty much at the end of the year. 13% return. So that's how I've done at the end of the year. If you compare it to S&P, Dow, 22, 29. The only way that you did 29% S&P this year is if you pulled every single dime out in the fourth quarter of 2018 and then put every single dime back in at the beginning. this 7% right here and that 7% right here, you might as well just subtract it off the top of these two numbers. Unless you were some like Miss Cleo savant Ouija board having investor who pulled every single dime out in December when the market dropped 13%. Like this entire Q1 right here was literally making up for Q4. I I I really want to just scream at people who are claiming that those are just real earnings. Um, that's why when you look at a lot of these YouTubers, if you look at their videos in December, they were hurting. But, you know, so you can subtract 13% off the top of this. I'm sorry. It is 16%. I don't care. We can argue this. But unless you were some genius who pulled every single dime out in Q4, the day Q4 started, and just knew magically, oh, I'm going to put it all back in on January 1st. Okay, then you made 29% this year. You know, you're a genius. Or if you're this guy right here, this 11%, so just straight up subtract it. It's up 11% this year. So I beat the Dow Jones. I'm right there equal or almost right there with the S&P. Now, if you're a NASDAQ guy, if you're one of those guys that went heavy into the NASDAQ, like some of these YouTubers, hey man, more power to you. You're the genius. But if I back this up to 2018, that was a NASDAQ at the end of 2018. Q4 2018. You're down 17%. So let's not pretend some of you guys are geniuses. So subtract 17% from that. You still up 21%, but I mean, come on, guys. Let's not pretend like every single person that's on YouTube or every person that's on TV was like, yes, Q4 2018, I'm going to pull all of my clients' money out, every dime at the 2018. And then, yes, the mystical fairy told me to put it all back in 20. Yeah, okay. If you did, hey, look, more power to you. You're a genius. You're up 38%. I, on the other hand, was conservative going into Q4. So Paul was only down 3.6%, while the rest of the market was down 13. You know, this is how I was doing. Okay? So while this market was down, Paul was pretty solid, okay? Look at that. 9%, 8%, 8%. Paul was down 2%, okay? So let's have a conversation about conservative portfolios, okay? So that's how I feel going into year end. I feel really good about 13.8% because I was conservative going into year end and I was conservative all throughout the year. And the reason why I'm still conservative. So let's go to the XLU. XLU is a utility tracking sector. XLU is where you go hide out when rates are going down and when you think the world's about to end. If I go out to the dot-com crash, XLU went up when everybody thought everything was fine. XLU went down. I can put, if you put the S&P or whatever on top of this, it's called an inverse correlation. Normally what happens is as the XLU is going up, the rest of it's going down. Every time that you get to a crash, dot-com crash, real estate crash, this is prior to Trump getting elected, you're kind of seeing these little mini crashes. And that's why you might as well call them that. If you zoom in on these things, you probably felt like it was the end of the damn world. But if everybody thinks everything's going to be okay, a lot of money comes out of the XLU. Okay, so for example, before the real estate crash, $38, it went down to $24 when it bottomed out. As far as I can see, the XLU is going up. Okay, there are a lot of investors who have a very, very, very large amount of money in safety still. So if they thought the economy was going to go great, this would have about 2 billion cut off the top of it, okay? Or 3 billion or 4 billion. There is a lot of people who are hiding out in safety probably for the rest of this bull market. There are a lot of people that are hiding out. The Fed would love all this money to come off of the sidelines because you might as well consider this the sidelines. Just people that are hanging out. They got in back. Just a lot of people that got in right around here or so that are just hanging out. If you look at my municipal funds, the exact same thing. The muni bonds that I have, this was a good trade for me prior to that tax bill being signed. I can play this out on municipal funds. If I go out max on these municipal funds, I mean, it almost plays out identical. You have a lot of people that just hide out in what I like to call safety, these tax-free things, and wait for the crash. Now they're missing this market, what they're calling a melt up, because there's just a lot of money being invested. But you have a lot of people sitting on the sidelines, or just instead of out of the market, they're hiding out somewhere. So a lot of them are hiding out international. This one right here, a lot of people are hiding out in this one. They're playing currencies right now. They're doing that type of thing. So what do I think is going to happen? I am still concerned about the corporate debt market. The reason why, as money has been piled, thank you Fed, into the market, you're getting into these types of PE ranges. 31 on Coke, okay? Disney, for example, if I go to Disney, 23 on Disney. Apple's at 18. Apple is normally at a 9 PE. This is insane. People are starting to like, oh, well, they're a software company now, or they're selling services. Services are only making up like 30%. Yeah, Apple would prefer for it to be like 70%. Right now, they're hardware. They get one bad super cycle, and they go down. Xerox is actually still at 13. They could actually go way, way higher. J&J, let me see where J&J is at. 22. Like, these valuations are insane. Like, the market it's normally at an 18. These companies are way high. So you might be asking yourself, well, what's all this mean? How does that all mean? Okay, the CFOs of these companies and the CEOs of these companies do not like these valuations. They want it lower. The way that they're going to get it lower is buying back their stock. And this is where you run into a problem. The Fed injects tons of money. And there's a reason why this has been called the buyback bull market. The Fed injects tons and tons of money. That money makes its way into the markets as liquidity. Because rich people, you can only buy so many yachts, okay? So They take the money. The people have access to this money that's being injected through these hedge funds and these money market people and the money makers or whatever they're called, and they inject that money right back into stocks. That drives up prices because you're buying stocks at very high prices. Companies have to deal with this, and the way that companies deal with this is what I'm about to show you. What they do is they go into the bond market and they issue debt. And what they do is they issue this debt and they buy back their shares. That's cool at the beginning of a market cycle. You can do that because you know that there's a good chance that they're going to be able to pay it off no problem. As you get further on, credit agencies even have to sit there and say, okay, guys, you're kind of getting high on your debt. How are you going to pay this back? If you don't have a way to pay this back, we're going to knock you out of the triple B and the A range, and we're going to knock you down into the high yield. And that's when you're supposed to start paying the high yield, right? That's why it's called high yield, HY, or junk markets, or whatever you want to call it. This is supposed to be the crap debt. What's happening, all this money's getting injected by the Fed. Stock prices are going higher. Well, to get those valuations down, they're going to have to buy back their stock, which means issuing debt to buy back their stock. Some insanity that's going on at the moment, and this is the craziest thing I've seen, is if you zoom in here, or if I put my phone in closer, on a high yield 6-month, 1.542. And this is just an average, but I mean 1.566. 9 months. Go out 1.643, 1.185, 1.8, 1.80. 30 years. Let's go out 30 years. 4.6, 4.4. The reason this is occurring is this. It's very simple. You have a lot of companies issuing a lot of debt in this range to control their valuations. So the stocks are going to have to respond, because when the first quarter or the fourth quarter, when they start reporting fourth quarter results, they're going to have to say we're buying back stock. They have no choice. It's because they have to bring down their valuations. You have some people, so a lot of these, the game is pretty much, people have kind of figured out the game already, so a lot of this is being pulled forward into December. And what that means is they're not pulling earnings forward, really. Even though you need the consumer to be healthy, they're pulling buybacks forward. You're expecting these companies to do buybacks, and they're going to have to. That's just a simple fact of life. One example of why you want to watch the corporate markets. So this was a few days ago. So a few days ago, Rite Aid has been up like 19% in the month of December. I haven't walked into a Rite Aid in probably years, but I noticed that two companies, if you ever go to CNBC, and you kind of look at their main page, they always have this little section down here, and E-Trade has this too. Anything that has a research area, it's kind of like what stocks are doing really, really good. So if you notice, CenturyLink was doing really, really good. They're up 2.365%. And then when you go to the debt markets, when you actually click on these triple Bs or these high yields, or if you go to these high yield area over here, this is kind of what they look like. So if you look at it, I took a screenshot. It says most active high yield corporates. Okay. And this basically tells you what stocks are crap and which ones are not crap, or which ones people think have a better chance of paying their money back. Rite Aid had 98 trades of their debt. You buy these in batches, and it was trading at 13.16%. Okay? CenturyLink, another one that's actually, if you go to the CNBC page right now, top trader right now, people are confident that they're going to be able to pay back their debt, so they're buying their debt. So yeah, the debt guys know what's going on. There's a reason why the debt market is bigger than the actual market itself. It's because the debt guys, yeah, the debt's where it's at. And these are the guys that are getting paid. These are the guys that put Toys R Us out of money. These are the guys that Toys R Us. I think they said a lot of people are under the misconception that Toys R Us was a horrible company and that they weren't profitable. Toys R Us was really profitable. They were making, I think, what it was like $1 billion or something like that. The problem was is that 90% of their money was in this stuff. Was paying back these guys, these guys right here. You know, you can pretty much tell what's going to go. Once this debt comes due, this 13%. I mean, come on, guys, really? CenturyLink, they're in the high yield market, but they were able to sell their debt at 2.93%, which is actually really good. Because if you look at the rest of these guys, like Teva, 6.42%, Transocean, 10.21. You know, CenturyLink is just, that's where they were. But another one that I wanted to show you is for the people that say QE has not affected the markets at all. Come on, guys. It's called easing for a reason. You're easing money into the markets. It is making its way into the market. One guy, I saw this on Twitter, and I thought it was just good to show you guys. So don't tell me that QE4, it's you can call it not QE, you can call it whatever you want. It's suppressing the short end of the curve of the treasury markets. It's what they're literally buying right now. Treasury is issuing it, Fed's buying it. It's just how this is working. Nobody wants it at those rates because I showed you what the rates that they could be getting. Like, why in God's name would you be buying this low debt? Especially for pension funds that have to show like 7% or 10% returns a year. Why in Christ's name would you be buying this 2% stuff? Or not even 2% stuff, this 1.5% stuff. So don't tell me QE hasn't affected the markets. It's a direct injection of money. And the people that have access to it, yeah, they're putting it to work. Because I'm not seeing the money come off the sidelines like some people are saying. This money's not coming off the sidelines unless they just had that much cash just sitting around. You show me the XLU drop by 20%, I'll tell you the money came off the sidelines. But, so it's just how I'm feeling. It's just how we are right now. Portfolio's doing really, really good. Going into the beginning of the year, the Fed is supposed to stop their QE on the 14th of January. And that's when I'm hoping earnings come out, or earnings should be coming out sometime in January. And then we'll kind of see how everything's going. See how the fourth quarter went. I walked around the mall recently. It wasn't vacant. The thing was packed. MasterCard recently came out and said everything's going good. So, yeah, I'm pretty confident right now that the first quarter isn't going to be horrible, especially with just this much stupid amount of money being injected. And the Fed can still cut. The Fed can still cut 3, 4 times, 5 times. If things start to fall apart again, it's just more capital injections. That's not even counting other central banks around the world that can still do capital injections. So I think we're pretty good right now, but it's all based on debt. If everything hits the fan, if everything like really, really hits the fan again, the Fed starts. The inflation is one that you have to watch. Inflation is going to be the story of 2020. If you see inflation take off, that's your sign that the Fed's going to have to start tightening. Jerome Powell's been very clear about this, but inflation's the really big one I watch. Consumer sentiment's one that I'm watching, but with this easy rates, as long as the consumer gets a little bit of the trickle down, everything should be fine. But consumer and inflation is what I'm watching going into 2020, and until I see those numbers fall apart, I feel confident. I'm actually for 2020, I'm going to slowly, as I get more money, as I make money, I'm going to shift this back to a 60-40 slowly through January and February. So as you check my videos and whatnot, you'll see this will slowly shift back to a 60-40. And it's basically going to be the stocks that you see right here: Xerox, Disney, J&J, LTC, O. I'll jump back into O. I'm waiting for O to come down to about 69. I'll jump if it came back down to 69, I'll jump back in. And then I'll up my exposure right here. This is the one I was at 11, or this was at an 11p. This was that high yield international one. I'll definitely jump back more into this. So these are just kind of the companies. Coke for sure. Without a doubt, I'll jump back in that. So what's effectively these consumer defensive companies, because at some point inflation is going to have to tick up. If you just look at oil alone, I wish I counted oil in there because they would have already had to do tightening if they included oil. But I'll be watching inflation. So if you have any questions, leave a comment. Like I said, if you see anything that I'm doing wrong or whatever, or I said wrong, feel free to correct me. I'll be happy to update it on the next video. Thank you for watching. Y'all have a nice day.